What if I told you that becoming a millionaire in the stock market doesn't require a PhD in finance, hours staring at charts, or jumping in and out of trades like a caffeinated day trader? What if the secret is actually shockingly simple, so simple that it fits into just 2 steps? Today, we're breaking down the book Buffett's 2-Step Stock Market Strategy by Danial Jiwani, and trust me, once you understand these 2 steps, you'll never look at investing the same way again. Because this isn't theory. This isn't hype. This is the strategy behind one of the richest investors on the planet. Warren Buffett, a man who turned a failing textile company into a multi-hundred-billion-dollar empire, using 2 principles that anyone can apply. And here's the part most people miss. Buffett didn't win because he bought thousands of stocks. He didn't win because he timed the market. He didn't win because he followed the news. He won because he mastered 2 questions. 1. Is this a wonderful business? 2. Am I buying it at a wonderful price? That's it. 2 questions that can change your financial life. But don't be fooled by the simplicity, because behind these 2 questions lies a set of insights so powerful they've helped countless everyday investors grow small accounts into life-changing wealth. This book exposes the psychological traps that make most people lose money, the hidden power of dividends that quietly build millionaires, why diversification can actually hurt you, and the emotional mistakes that kill returns faster than any market crash. It shows you why great businesses are like great relationships: predictable, trustworthy, and able to grow with time, and why the price you pay determines whether you build wealth or just hope for it. Imagine knowing exactly what to look for before buying a stock. Imagine knowing when to sell without second-guessing yourself. Imagine investing in a way that's calm, rational, and built to last. That's what this book delivers. So in this summary, we're going to decode Buffett's legendary 2-step method using real examples, simple explanations, and lessons you can apply today even if you're just starting out. Because financial freedom doesn't come from guessing the next hot stock. It comes from understanding the kind of businesses that win over decades. And by the end of this video, you'll walk away with a mindset shift that separates average investors from great ones. You'll understand how millionaires think, how they evaluate opportunities, and why patience is the most underrated wealth-building skill in the world. If you're ready to learn the strategy Buffett used to turn long-term investing into a superpower, buckle up. This might be the most important 2-step process you ever learn. Chapter 1 opens with a simple but powerful message. Most people fail at investing not because the stock market is too complicated, but because they never learn the one principle that drives every successful long-term investor. Danial Jiwani calls this the ultimate principle of investing, and it's the same philosophy Warren Buffett has followed for decades. The chapter begins by breaking down a common misunderstanding. People think investing is about predicting the market. They watch the news, study economic forecasts, or react to short-term price movements. But according to Buffett, and emphasized by Jiwani, investing has nothing to do with predicting what the market will do tomorrow. It's about understanding what a business will become over the next 10, 20, or 30 years. So the ultimate principle is this: invest in a business, not a stock. Your job is not to guess prices, but to evaluate the quality and long-term durability of a company. Jiwani explains that Buffett doesn't see the stock market as a casino. Instead, he sees it as a place where you can buy ownership in real businesses with real earnings, real customers, and real futures. Once you internalize this mindset, everything changes. The noise fades away. You stop chasing trends. You stop worrying about daily volatility. And instead, you start thinking like a business owner. To drive this home, the author uses the classic Buffett example. If the stock market shut down for 5 years and you couldn't sell anything, would you still want to own the companies in your portfolio? If the answer is no, then you're not investing, you're speculating. The chapter stresses that speculation is the enemy of wealth. Speculators hope prices will rise. Investors focus on whether the underlying business will grow. And over time, the market always aligns with business fundamentals. A great business will eventually reflect a great stock price, even if it takes patience to see it. Jiwani then shifts to the second part of the principle. The market is emotional, but investors cannot be. Buffett often says the market in the short run is a voting machine, full of emotion, hype, and fear, but in the long run, it's a weighing machine that measures a company's true value. Chapter 1 uses this idea to emphasize why investors must detach themselves from market mood swings. The moment you let emotions dictate decisions, you're no longer following the ultimate principle. Fear makes investors sell great companies during downturns. Greed makes them buy low-quality companies during hype cycles. The purpose of this book, especially the first chapter, is to help readers build a mindset that protects them from these psychological traps. Next, Jiwani introduces the foundation for the rest of the book, Buffett's two-step strategy. He doesn't dive into the steps yet, that comes in the next chapters, but he prepares the reader by explaining why only 2 steps are needed. Successful investing doesn't come from complex formulas or following dozens of indicators. It comes from mastering the fundamentals so deeply that every decision becomes clear. And the first chapter connects this simplicity to Buffett's results. Buffett became one of the world's richest men not by trading constantly, but by applying the ultimate principle with discipline. He stayed focused on business quality. He avoided emotional decisions, and he made huge, concentrated bets only when the business was clearly excellent and the price was clearly justified. The chapter concludes by reinforcing the key takeaway. If you want to invest like Buffett, you must adopt the mindset of a business owner. Think in decades, not days. Your goal is not to react to the market, it's to outlast it. Jiwani promises that once the reader understands and applies this principle, the rest of Buffett's strategy becomes much easier. Without this foundation, the 2 steps won't work, but with it, the investor gains a framework that cuts through noise, fear, and confusion and opens the door to long-term financial success. Chapter 2 marks the beginning of the first step of Buffett's strategy, finding a wonderful business. Danial Jiwani explains that this step is the foundation of everything Buffett does. Before thinking about price, timing, or market conditions, Buffett focuses on one thing: is this business truly exceptional? If the answer is no, the process ends there. The chapter opens by clarifying what wonderful actually means in the Buffett framework. It does not mean trendy, fast-growing, or popular. A wonderful business is one that can generate consistent, durable, and predictable earnings over long periods of time. Jiwani emphasizes that Buffett is not seeking excitement. He is seeking reliability. Wonderful businesses have the kind of strength that makes them hard to disrupt, easy to understand, and capable of producing cash year after year. To help readers identify these types of companies, Jiwani introduces the concept of economic moats, a core element in Buffett's thinking. A moat is anything that protects a business from competition. The stronger the moat, the harder it is for competitors to take market share or replicate the company's advantages. Chapter 2 details several types of moats: brand strength, cost advantages, network effects, patents, scale efficiency. But the message is simple: a wonderful business must be protected. Without protection, profits will eventually disappear. Next, the chapter breaks down why simplicity matters so much. Buffett famously avoids businesses he doesn't understand, no matter how attractive the headlines may look. Jiwani echoes this principle. If you cannot explain how a company makes money, and why that money will continue to come in for the next decade, then you cannot evaluate it properly. Complexity increases uncertainty, and uncertainty increases risk. Wonderful businesses, on the other hand, tend to operate models that are clean, straightforward, and predictable. Jiwani then transitions into the importance of consistent financial performance. A wonderful business must show stability in revenue, margins, and profits. Trends should be steady upward, not erratic, cyclical, or fragile. The chapter highlights that this consistency reflects a strong underlying business model and disciplined management. Companies with wild fluctuations may still be good businesses, but they are not wonderful by Buffett's definition because they introduce unnecessary unpredictability. A major section of Chapter 2 focuses on return on equity ROE and return on invested capital ROIC. These metrics reveal how efficiently a business turns investment into profit. Buffett looks for companies that consistently earn high returns without requiring excessive debt. Jiwani stresses that high debt hides weakness. It can boost numbers temporarily, but increases long-term risk. Buffett wants businesses that generate strong results because they're fundamentally great, not because they're financially engineered. The chapter also emphasizes the importance of management quality. Wonderful businesses are often led by disciplined, long-term thinkers who treat shareholders like partners. Jiwani explains that Buffett prefers leaders who allocate capital intelligently, avoid chasing trends, and resist the pressure to impress Wall Street with short-term performance. Good management maintains the moat and protects shareholder value. Poor management destroys both. Jiwani brings all these elements together to form a clear checklist for identifying a wonderful business: a strong, durable economic moat, a simple and understandable business model, consistent earnings and predictable cash flow, high returns on capital with low reliance on debt, trustworthy, rational management, long-term durability in the industry. He emphasizes that these qualities are non-negotiable. Investors who compromise on these characteristics end up owning mediocre businesses that look good temporarily but fail under pressure. The chapter ends by tying back to the mindset introduced in Chapter 1. Finding a wonderful business is about thinking like a long-term owner. Buffett's question is always the same: if I buy this company, would I want to own all of it for decades? If the business is not durable, simple, and consistently profitable, the answer is no. Jiwani closes Chapter 2 by reminding readers that wonderful businesses are rare, and that rarity is part of the value. Most companies do not meet Buffett's standards, but those that do can produce exceptional returns for decades, which is precisely why Step 1 must be done with care, patience, and discipline. The rest of the strategy depends on this step being done correctly. Chapter 3 introduces the second step of Buffett's method: determining whether the price you pay for a wonderful business is truly a wonderful price. Danial Jiwani highlights that even the best business becomes a bad investment if you pay too much for it. Price is the bridge between quality and returns, and Buffett treats this step with the same discipline as evaluating the business itself. The chapter begins with a fundamental principle: value and price are not the same thing. Price is what the market demands today. Value is what the business is actually worth based on its ability to generate future cash. A wonderful price exists only when value significantly exceeds price. A gap Buffett calls a margin of safety. This margin protects investors from errors, uncertainty, and unpredictable market events. Jiwani then explains why most investors struggle with this step. They focus on short-term market moves instead of long-term intrinsic value. Buffett ignores short-term fluctuations entirely. Instead, he works backward. He looks at the company's fundamentals and estimates its long-term earning power. If the market price offers a meaningful discount to that intrinsic value, then it becomes a buying opportunity. To guide readers, the chapter introduces the concept of intrinsic value, which represents the total cash the business will generate over its lifetime, discounted back to the present. While Buffett never uses a complex formula, Jiwani emphasizes that investors must understand the logic behind it. The real worth of a company lies in its future cash flow, not in temporary hype or fear-driven pricing. One of the core tools Buffett relies on is the company's earnings power. Jiwani explains that Buffett looks for businesses with stable, predictable earnings because they allow investors to make reliable long-term projections. Volatile earnings make valuation uncertain, which increases risk. A wonderful business with consistent historical earnings provides a strong foundation for estimating its future potential. The chapter then introduces the idea of owner earnings, a metric Buffett prefers over reported earnings. Owner earnings represent the actual cash available to shareholders after accounting for necessary reinvestment to maintain the business. This metric strips away accounting tricks and reveals the true profitability of a company. Jiwani emphasizes that owner earnings help investors see the business the way Buffett does, as a machine that converts capital into cash. Another major topic in Chapter 3 is the price-to-earnings P/E ratio. But Jiwani clarifies that Buffett doesn't rely on this metric alone. A low P/E does not guarantee a bargain, and a high P/E does not automatically mean overvaluation. Instead, Buffett evaluates the P/E in the context of the business's quality, growth, moat strength, and consistency. A wonderful business may deserve a premium, but only up to a point. Meanwhile, a mediocre business can look cheap but still be a poor investment. Jiwani also highlights the role of growth in determining a wonderful price. Steady, predictable growth enhances intrinsic value, but speculative or aggressive growth assumptions can distort valuation. Buffett prefers modest, realistic growth forecasts and avoids businesses that require high growth to justify their price. The less growth a company needs to remain attractive, the safer the investment. A key challenge the chapter addresses is timing. Many investors wait for the perfect price and end up doing nothing. Buffett takes a different approach. He remains patient but ready. When a wonderful business drops to a wonderful price due to temporary market pessimism, he acts decisively. Jiwani calls this the prepared mind advantage, emphasizing that investors who understand value in advance can move quickly when opportunities appear. Chapter 3 also discusses market psychology, which frequently creates mispricing. Fear pushes stocks below intrinsic value. Greed pushes them above it. Buffett's discipline lies in staying anchored to the company's fundamentals, rather than reacting to crowd behavior. Jiwani explains that mispricing is not a rare exception. It's a recurring feature of markets. Those who recognize it can consistently find wonderful prices for wonderful businesses. The chapter concludes by aligning Step 2 with Step 1. Once an investor finds a wonderful business, the only remaining task is to determine whether the current market price provides adequate margin of safety. Without this margin, even the best company becomes a risky investment. With it, long-term returns can compound in extraordinary ways. Jiwani ends by reinforcing Buffett's mindset. It's better to buy a great business at a fair price than a fair business at a great price. But the ultimate goal is still to buy great businesses at great prices. And Step 2 gives investors a practical framework to recognize those rare opportunities. Chapter 4 shifts the focus from valuation to one of the most reliable and misunderstood tools available to long-term investors: dividends. Danial Jiwani explains that dividend investing is not about chasing yield or looking for high payouts. Instead, it's about understanding how dividends fit into Buffett's broader philosophy of owning wonderful businesses for decades. The chapter shows why dividends matter, how they strengthen total returns, and how they help investors stay disciplined over long periods of time. The chapter opens with a foundational idea: a business that consistently generates excess cash and can return part of that cash to shareholders is usually a high-quality business. Dividends signal profitability, stability, and financial discipline. Companies that can pay dividends year after year often have strong moats, predictable earnings, and management teams that prioritize long-term value creation. Jiwani distinguishes between two types of investors: those who chase high dividend yields, those who seek high-quality companies that happen to pay dividends. Buffett belongs firmly to the second group. He does not buy companies because they pay dividends. He buys wonderful businesses, and many of those businesses naturally produce enough cash to distribute dividends over time. The dividend is an outcome of business strength, not the main reason to invest. A major concept in this chapter is dividend growth. Jiwani emphasizes that the power of dividends comes not from the initial yield, but from the company's ability to increase dividends consistently. A business that raises its dividend every year shows that it is growing earnings, protecting its moat, and allocating capital responsibly. Dividend growth also accelerates compounding because each increase boosts the investor's return without them needing to buy more shares. Jiwani reinforces this idea with the principle of total return, which combines three components: price appreciation, dividend income, dividend growth. Dividend-focused investors often focus only on the income portion, but Buffett looks at total return. A company with modest dividend yield, but strong growth and durable competitive advantages, usually delivers superior long-term results compared to companies with high yields, but weak fundamentals. The chapter also highlights an important behavioral benefit: dividends help investors stay invested, especially during market downturns. When prices fall, dividend payments continue to rise. The steady cash flow reduces emotional fear and reinforces the mindset of being an owner, rather than a trader. Jiwani calls dividends a psychological anchor that keeps investors focused on fundamentals instead of volatility. Another key point is dividend sustainability. Not all dividends are created equal. Jiwani warns that some companies pay high dividends only because management wants to attract investors or compensate for weak growth prospects. These payouts are at risk of being cut, which often leads to sharp stock price declines. Buffett avoids companies with unstable or artificially high dividends. Instead, he prefers businesses with low payout ratios, strong cash flow, and clear capacity to reinvest while still rewarding shareholders. The chapter also introduces the concept of yield on cost, a long-term investor's secret weapon. Yield on cost measures the dividend you receive relative to the price you originally paid for the stock. Over years of dividend increases, yield on cost can rise dramatically. Jiwani illustrates how a company that originally pays a 3% yield might grow its dividend enough to deliver 10% or more on the investor's initial cost. After a decade or two, this is where dividend investing becomes extremely powerful. Jiwani then ties dividends back to Buffett's two-step strategy. Wonderful businesses typically have strong economics that produce excess cash. If a wonderful business is selling at a wonderful price, the combination of dividends, dividend growth, and capital appreciation becomes a powerful long-term engine of compounding. Dividends also make intrinsic value easier to estimate because cash returns reduce uncertainty and make future projections more grounded. The chapter concludes with the key message: dividends strengthen both the math and the psychology of long-term investing. They provide measurable cash flow, reinforce the notion of ownership, reward patience, and make compounding more tangible. But dividends only work when paired with Buffett's core principles: high-quality businesses, durable moats, consistent earnings, and rational management. When those elements are in place, dividend investing becomes not just a strategy, but an accelerant to financial freedom. Chapter 5 tackles one of the most commonly repeated ideas in investing: diversify to reduce risk. Danial Jiwani explains that while diversification can protect inexperienced investors from catastrophic mistakes, it can also dilute returns and weaken the impact of owning truly exceptional businesses. Warren Buffett's view is straightforward: diversification is only necessary when investors don't understand what they're doing. For those who can identify wonderful businesses, over-diversification becomes a drag, not a safeguard. The chapter opens by contrasting two mindsets: the defensive investor, who spreads money across many assets to compensate for uncertainty; the knowledgeable investor, who concentrates capital in a small number of high-quality opportunities. Jiwani emphasizes that Buffett belongs firmly in the second group. Buffett prefers to hold a focused portfolio of businesses he deeply understands, believing that concentration maximizes the rewards of careful analysis. Diversification, on the other hand, can lead investors to own mediocre businesses simply for the sake of adding more names to a list. Chapter 5 clarifies that diversification is not inherently bad. It protects beginners who have not yet learned to evaluate business quality, intrinsic value, or moat durability. The problem arises when diversification becomes automatic, not deliberate. Many investors spread their capital widely because they are afraid of being wrong, not because they have found multiple compelling opportunities. Jiwani argues that fear-driven diversification often results in owning average companies that offer average returns. The chapter then explores the mathematical and practical limits of diversification. Jiwani explains that the majority of diversification benefits occur with the first few stocks. Going from 1 stock to 10 stocks dramatically reduces company-specific risk, but going from 10 to 20 adds less benefit, and going beyond 20 usually adds noise rather than protection. At that point, investors are simply collecting tickers, not building conviction. This leads to one of Buffett's key principles: put meaningful money behind your best ideas. If you find a wonderful business trading at a wonderful price, spreading capital thinly across dozens of lower-quality companies weakens your results. Concentration amplifies your research, your discipline, and your insights. Diversification, when overdone, mutes them. To illustrate this, Jiwani describes how great businesses compound returns over decades. The effect is exponential. A small number of exceptional companies can carry an entire portfolio's long-term performance. Over-diversifying dilutes the impact of this compounding because resources get diverted to companies that cannot match the performance of the very best ones. The chapter also addresses the psychological component of diversification. Many investors diversify because it feels safer, not because it improves results. Owning a broad portfolio gives the illusion of protection. But Jiwani points out that emotional comfort and rational decision-making are not the same thing. Investors who diversify excessively often end up with a portfolio they don't understand and cannot monitor effectively. Without understanding, they cannot make good decisions during volatility. Buffett's approach emphasizes the opposite. Know your businesses so well that you can hold them confidently through downturns. Concentration increases the need for clarity, discipline, and patience. It forces investors to think carefully before buying. Over-diversification encourages impulsive decisions because the stakes feel lower with each individual position. Another key point in Chapter 5 is the idea of diversification. Diversification that actively harms returns. This happens when investors chase additional stocks for the sake of novelty, balance, or trend following. Jiwani explains that diversification often leads to buying companies outside the investor's circle of competence. Once investors begin including businesses they do not fully understand, the ultimate principle of investing, treating stock ownership like business ownership, breaks down. The chapter then reaffirms Buffett's core requirement for concentration, a strong circle of competence. Investors should concentrate only when they possess deep understanding of the business, its moat, its management, and its long-term prospects. Concentration without knowledge becomes speculation. But concentration with knowledge becomes a powerful engine for superior returns. Jiwani concludes Chapter 5 with a balanced message. Diversification protects investors who lack confidence or expertise, but it limits those who have the ability to identify wonderful businesses and evaluate them accurately. The goal is not to avoid diversification entirely, but to use it intentionally, not fearfully. Buffett's strategy encourages investors to build conviction and put more capital behind exceptional opportunities rather than spreading it thinly across many average ones. The final takeaway is clear. Diversification is a tool, not a requirement. When used correctly, it reduces risk. When overused, it reduces returns. Mastering Buffett's strategy means knowing when diversification helps and when it hurts. Chapter 6 focuses on one of the most destructive forces in investing: emotion-driven decision-making. Danial Jiwani emphasizes that even with a solid strategy, strong analysis, and high-quality companies, investors can still underperform if they allow emotions to override logic. Warren Buffett repeatedly warns that emotional discipline is far more important than intelligence in long-term investing. This chapter explains why emotions cause investors to make poor decisions and how Buffett's framework protects against those mistakes. The chapter opens by establishing a simple truth: the stock market is a machine that amplifies human psychology. Prices swing dramatically not because businesses suddenly change overnight, but because people react to news, rumors, volatility, or fear. These emotional reactions lead investors to buy high during euphoria and sell low during panic, the exact opposite of rational behavior. Jiwani identifies two core emotions that consistently harm returns: fear, which pushes investors out of great businesses when prices drop; greed, which lures investors into overpriced companies or risky trends when optimism peaks. Buffett's philosophy is built around neutralizing both forces. He does this by anchoring every decision to the intrinsic value of the business, rather than the daily market price. Chapter 6 explains that emotions only take control when investors focus on price movement instead of business fundamentals. A central idea in this chapter is Mr. Market, a famous metaphor from Benjamin Graham. Jiwani uses it to show how irrational the market can be. Mr. Market offers you different prices every day, sometimes extremely high, sometimes extremely low. But the key insight is this: you are never obligated to act on his offers. The only time you should act is when price disconnects dramatically from value. This reinforces the discipline of ignoring emotional noise and waiting for logical opportunities. The chapter then examines how fear typically manifests during market downturns. When stock prices fall sharply, even high-quality companies can get sold off. Investors panic because they anchor their emotions to price movement instead of the company's long-term performance. Jiwani stresses that temporary price declines do not change a company's intrinsic value. Buffett consistently views downturns as buying opportunities, not signals to run away. On the opposite side, greed becomes dangerous during bull markets. When prices rise quickly, investors start believing every upward trend will continue indefinitely. They chase stocks without understanding the business, or they pay excessive prices for mediocre companies simply because they don't want to miss out. Chapter 6 explains that this fear of missing out, FOMO, is one of the strongest emotional triggers in markets. Buffett avoids it by refusing to buy businesses he doesn't understand or companies priced far above their intrinsic value. Another major section highlights confirmation bias and availability bias to psychological traps that make investors selectively interpret information. Confirmation bias leads investors to look only for data that supports their current opinion. Availability bias makes recent or dramatic events feel more important than they actually are. Jiwani explains that these biases amplify emotional decisions, pushing investors to hold onto losing stocks or chase popular narratives. Buffett counters this by relying on principles, not predictions. He bases decisions on stable, long-term business performance, not recent headlines. The chapter also discusses overtrading, which often results from emotional impulses. Investors who constantly buy and sell try to correct mistakes quickly or chase new opportunities. But Jiwani warns that overtrading leads to higher costs, lower returns, and emotional turbulence. Buffett's approach is the opposite. He buys rarely, sells rarely, and lets compounding do the heavy lifting. Emotional investors act frequently. Disciplined investors act selectively. A critical point in Chapter 6 is the role of a clearly defined process. In preventing emotional decisions, Buffett's two-step strategy is intentionally simple. By focusing on business quality and buying only at wonderful prices, investors automatically screen out emotional noise. The strategy itself acts as a psychological guardrail. Jiwani concludes the chapter by reinforcing that emotional control is not optional. It is essential. The difference between successful and unsuccessful investors often has nothing to do with intelligence or tools. It comes down to temperament. Investors who can remain rational when others panic or celebrate excessively gain a permanent advantage. The final message: emotions are the silent killer of investment returns. Mastering Buffett's strategy requires mastering your behavior. If you can stay disciplined, patient, and grounded in intrinsic value, the market's emotional swings become opportunities, not threats. Chapter 7 focuses on a critical, but often overlooked idea in investing. Market capitalization shapes the type of opportunities available to different investors. Danial Jiwani explains that understanding market cap is not just about classifying companies as small cap, mid cap, or large cap. It's about recognizing which categories offer the best opportunities, depending on your size, strategy, and capabilities as an investor. The chapter opens by defining market capitalization simply: the market value of a company, calculated by multiplying the share price by the number of outstanding shares. Jiwani highlights that Buffett's strategy is deeply influenced by this metric. It determines not only what Buffett can invest in, but also what he can't. As Berkshire Hathaway grew into a giant, many smaller opportunities became irrelevant because they couldn't meaningfully move the needle for such a large pool of capital. This introduces the central theme of Chapter 7. Size limits opportunity. The bigger the investor, the fewer opportunities remain that can produce meaningful returns. Conversely, smaller investors have access to opportunities Buffett himself can no longer exploit. Jiwani uses this idea to emphasize a key advantage individual investors often forget they have: flexibility. Large institutions and billionaire investors need to deploy billions into each investment. They cannot take positions in small or micro-cap companies. because their buying pressure alone would distort prices, or because the opportunity is simply too small to make an impact. Individual investors, however, can benefit from these inefficiencies because they can invest small amounts without moving the market. The chapter then explains the trade-offs of each market cap category. Small cap and micro cap companies. These companies often have higher growth potential because they are early in their development. They may operate in niche markets, innovate faster, or have room to expand. However, they also come with higher risk, limited financial resources, less predictable earnings, and narrower economic moats. Jiwani stresses that Buffett's principles still apply here. Investors must look for durability, quality, and intrinsic value. But smaller companies can offer exceptional opportunities for those who do the research and stay within their circle of competence. Mid-cap companies. These businesses often have proven models with room for further growth. They are more stable than small caps, yet still flexible enough to expand. Jiwani notes that many wonderful businesses were once mid-caps before becoming household names. These companies can strike a balance between growth potential and stability. Large-cap companies. Large caps are usually established giants with strong moats, consistent earnings, and lower volatility. Buffett invests heavily in this category because Berkshire's size requires it. But Jiwani warns that large caps often trade at higher valuations and deliver slower growth because most of their expansion already happened in earlier decades. Chapter 7 highlights a critical insight. Investing success depends on matching your opportunity set with your capital base. Large investors must focus on big, stable companies. Individual investors can explore smaller businesses where mispricing is more common. Buffett frequently acknowledges this. He has said many times that he could generate higher returns if he managed less money. The chapter also addresses how market capitalization affects competition. Small companies face less analyst coverage, fewer institutional investors, and lower public scrutiny. This lack of attention creates inefficiencies, which is another advantage for well-informed individual investors. Large companies, by contrast, are heavily analyzed and widely understood, making it harder to find undervalued opportunities. Jiwani brings the discussion back to Buffett's strategy by emphasizing that wonderful opportunities exist across all market cap levels, but the criteria never change. Regardless of size, the business must still have a durable moat, strong economics, predictable earnings, trustworthy management, intrinsic value far above its price. Market cap only determines where these opportunities are most likely to appear. For different types of investors, the chapter concludes by encouraging investors to take advantage of their scale. Rather than imitate large institutions, the goal is not to copy Buffett's portfolio, but to copy his principles. Those principles, understanding the business, valuing it correctly, and waiting for the right price, apply to all market caps. But the best opportunities for each investor depend on the size of the capital they control. The final message is clear. Market capitalization is not a barrier, it's a filter. Individual investors who recognize their flexibility can find opportunities Buffett himself would take if he weren't managing billions. Chapter 8 shifts the focus from selecting businesses and determining prices to the pre-investment preparation process. The practical steps every investor should take before putting $1 into the market. Danial Jiwani explains that great investing is not only about what you buy, it's also about how to prepare your financial foundation and decision-making system. This chapter outlines the essential checklist Buffett would expect any rational investor to follow long before analyzing a single stock. The chapter begins with a crucial principle. Investing works only when your financial life is stable. If your personal finances are chaotic, emotional pressure will inevitably spill into your investment behavior. Investors without a solid foundation tend to panic during downturns, sell too early, or chase quick gains. Jiwani emphasizes that emotional discipline, discussed in Chapter 6, begins with being financially secure outside the stock market. The first step is establishing a strong emergency fund. Jiwani recommends that investors keep enough cash to cover several months of essential expenses. This buffer ensures that market volatility won't force anyone to liquidate investments at the wrong time. Buffett's philosophy hinges on patience, and patience is only possible when investors aren't financially stretched. The second step is managing high-interest debt. Jiwani states plainly, no stock market return can consistently beat the cost of compounding debt. If a credit card charges 18% interest, expecting your investments to outperform that rate is unrealistic. Buffett's strategy assumes rational decision-making, and paying off expensive debt is one of the most rational financial moves a person can make. Next, the chapter stresses the importance of budgeting and consistent saving habits. Investing is not effective without capital, and disciplined savings are how long-term compounding begins. Jiwani explains that Buffett's results came not from making a few lucky investments, but from decades of continuous capital allocation. Individual investors should adopt the same mindset. Treat saving as a routine part of life, not an occasional event. Once personal finances are stable, Jiwani introduces the next step, defining your circle of competence. Investors must understand what kinds of businesses they can analyze effectively. Buffett avoids industries he doesn't understand, no matter how profitable they appear. Chapter 8 emphasizes that this discipline prevents emotional decision-making and reduces mistakes. A clear circle of competence acts as a personal filter, narrowing the universe of potential investments to businesses an investor can evaluate confidently. The chapter then moves into the importance of research preparation. Jiwani explains that thorough pre-investing research doesn't begin with numbers. It begins with understanding the business model. Investors should review how the company makes money, who its customers are, how it maintains its moat, and what long-term risks could disrupt the business. Only after understanding the business qualitatively should investors begin analyzing financial statements, margins, and cash flow. Jiwani also highlights the need for checklist-based decision-making. Buffett uses principles that work as an internal checklist: consistent earnings, high returns on capital, low debt, trustworthy management, and durable moats. Chapter 8 recommends that individual investors build their own checklists to ensure they don't overlook critical information. Checklists counter emotional decision-making by forcing investors to judge companies against objective criteria rather than short-term market noise. Another critical step before investing is setting clear expectations and time horizons. Jiwani emphasizes that stocks should be bought with the intention of holding them for years, not months. If an investor is planning to sell quickly or is expecting rapid gains, they are not following Buffett's principles. Long-term horizons protect investors from reacting to temporary volatility and align their mindset with intrinsic value, not price fluctuations. Chapter 8 also discusses the importance of ignoring market predictions. Jiwani reminds readers that economists, analysts, and financial media often attempt to forecast market direction, interest rates, or global events. Buffett pays no attention to these predictions because they do not influence a company's long-term earnings power. Investors who rely on forecasts become reactive. Investors who rely on business fundamentals remain grounded. Finally, the chapter concludes with a focus on building investment discipline before investing. Jiwani argues that discipline must be intentional. Investors should create a written plan outlining why they are buying a business, what they believe its intrinsic value is, and under what conditions they would sell. This eliminates impulsive behavior and provides clarity during market volatility. The core message of Chapter 8 is clear. Successful investing begins long before you buy a stock. By stabilizing personal finances, defining your circle of competence, building a research framework, and preparing emotionally and intellectually, you set the stage for rational, Buffett-style decision-making. These steps ensure that when the right opportunity appears, you are ready financially, mentally, and strategically. Chapter 9 addresses one of the hardest decisions investors face: knowing when to sell. According to Danial Jiwani, selling is often more emotionally charged and more damaging to long-term results than buying. Warren Buffett's approach is simple but extremely disciplined. Selling should be rare, intentional, and driven by clear principles. This chapter outlines those principles and explains why most investors get selling wrong. The chapter opens with a key truth: great businesses owned at wonderful prices should be held for as long as they remain great. The natural tendency to react to price movements especially short-term gains or losses, leads investors to sell too early or for the wrong reasons. Jiwani emphasizes that selling based on emotions, predictions, or volatility almost always destroys compounding. To clarify when selling should occur, the chapter breaks it down into 3 legitimate reasons to sell. 1. The business quality declines. The first and most important reason to sell is when the business itself weakens. Buffett invests based on the long-term economics of a company. If those economics erode, the original investment thesis is no longer valid. Signs of declining business quality include loss of competitive advantage or weakening moat, inconsistent earnings or deteriorating financial performance, management making poor capital allocation decisions, increasing debt that threatens long-term stability, disruption from new competitors or technology shifts. Jiwani stresses that temporary issues are not reasons to sell. Cyclical downturns, short-term earnings dips, or market corrections do not change intrinsic value. What matters is structural decline, changes that permanently harm the business. Buffett's rule: if the reason you bought the company no longer exists, you sell. But this requires objective evaluation, not emotional reaction. 2. The stock becomes significantly overvalued. The second reason to sell is when the market price rises so far above intrinsic value that future returns become unattractive. A wonderful business can still be a bad investment if its price becomes disconnected from reality. However, Jiwani notes that Buffett is extremely cautious about selling purely due to overvaluation. Buffett would rather hold a great business through periods of high valuation than risk paying taxes, losing ownership of a compounder, or trying to time the market. Selling based on valuation requires an unusually large gap between price and intrinsic value, not small fluctuations. The logic is simple. If the price becomes irrationally high and the risks outweigh the potential returns, selling may be justified. But for most long-term compounders, this situation is rare. 3. You find a clearly superior opportunity. The third reason to sell is when capital can be reallocated to a significantly better investment. Because capital is limited, moving money from a good business to a great business can increase long-term returns. Jiwani stresses that this reason must be used carefully. Investors often convince themselves that a new opportunity is better simply because it is novel or currently popular. Buffett avoids this trap by comparing opportunities using the same criteria: moats, management, economics, and price. If a new business is only slightly better, the switching cost may not justify selling. But if the new opportunity is clearly superior, selling the inferior one can be rational. Why not to sell? Chapter 9 also outlines the most common wrong reasons investors sell, and why Buffett ignores all of them. Price dropped and fear takes over. Price increased and greed encourages profit-taking. Market predictions or economic forecasts. News headlines and analyst commentary. Temporary earnings volatility. Desire to lock in gains without evaluating intrinsic value. Jiwani explains that these reasons sabotage compounding. The best investments generate the largest returns in the last years of ownership, not the first. Selling early interrupts the compounding curve and replaces patience with emotional decision-making. The role of patience. A major theme in this chapter is that selling rarely leads to better long-term results. Buffett's enormous wealth came not from buying and selling frequently, but from buying selectively and holding for decades. Jiwani highlights that selling is often a psychological escape, an attempt to control volatility or avoid discomfort. But discomfort is normal, while compounding is fragile. The chapter emphasizes that the default action for a long-term investor should be not selling. Selling should occur only when facts change, not when emotions fluctuate. Final message. Jiwani concludes Chapter 9 with Buffett's mindset. Our favorite holding period is forever, but only if the business stays wonderful. Sell only when the business weakens, or when valuation becomes extreme, or when a truly superior opportunity appears. Everything else is noise. Chapter 10 serves as the final consolidation of everything Danial Jiwani has built throughout the book. Instead of introducing new concepts, the chapter reinforces the core framework of Buffett's investment philosophy. and clarifies how the two-step strategy fits together into a practical, lifelong approach. The emphasis is simple. Successful investing does not require complexity. It requires consistency, discipline, and the right mindset. The chapter begins by revisiting the ultimate principle introduced in Chapter 1. Invest in businesses, not stocks. Everything else in the book flows directly from this mindset. Jiwani stresses that investors must view themselves as partial owners of real companies, with long-term earnings power, not as traders trying to profit from short-term price changes. When investors adopt this perspective, the chaotic movements of the market fade into the background, and the focus shifts to business quality and intrinsic value. Jiwani then summarizes the first step, finding a wonderful business. The book repeatedly explains that these businesses are rare. They have durable competitive advantages, strong and predictable earnings, trustworthy management, low reliance on debt, and the ability to generate consistent returns on capital. The conclusion reinforces that investors must be highly selective. Owning a small number of exceptional businesses is far superior to building a large portfolio of average ones. Next, the chapter revisits the second step, determining a wonderful price. Even the best business becomes a bad investment if bought at an overpriced level. Jiwani emphasizes that investors must understand the difference between price and value, rely on long-term cash generation rather than market predictions, and insist on a margin of safety. Buffett's approach is not about forecasting market direction, but about identifying times when the market undervalues great companies due to fear or short-term pessimism. The conclusion connects both steps with an important message: the strategy works only if investors manage their emotions. Chapters 6 and 9 highlight how fear, greed, and impatience can destroy returns faster than any external factor. The final chapter reinforces this point. Buffett's success is as much about temperament as it is about analysis. The ability to stay rational, stick to a process, and ignore noise is what ultimately separates great investors from the rest. Jiwani then transitions into a broader reflection on long-term investing. Compounding requires time, stability, and patience. Investors must avoid the temptation to constantly trade, switch strategies, or chase trends. The conclusion reminds the reader that the best returns often appear only after years of holding wonderful businesses. Selling too early, acting on predictions, or reacting to volatility interrupts the compounding process and limits wealth creation. The chapter also expands on the investor's advantage based on size, covered in Chapter 7. Individual investors don't need to deploy billions of dollars, and therefore enjoy flexibility Buffett no longer has. The conclusion encourages readers not to copy Buffett's stock picks, but to copy his principles. Individuals can access opportunities in market segments ignored by large funds, especially small and mid-cap businesses with strong economics. This reinforces the idea that the two-step strategy is universally available, regardless of investor size. Jiwani also revisits the importance of preparation, explored in Chapter 8. The conclusion makes it clear that investors are far more likely to succeed when their personal finances are stable, when they work within a clear circle of competence, and when they follow a checklist that keeps emotions under control. Investing starts long before money enters the market. Proper preparation ensures clear thinking, rational actions, and patience when volatility inevitably appears. Toward the end, Jiwani synthesizes everything into a practical message. Buffett's method is simple on purpose. Not easy, but simple. It removes noise, eliminates unnecessary complexity, and forces investors to focus on what truly matters: business quality, valuation, and discipline. The market will always fluctuate. News headlines will always create fear or excitement, and trends will always rise and fall. But wonderful businesses purchased at wonderful prices remain resilient across decades. The chapter closes by encouraging investors to approach the market with humility and patience. There is no perfect formula, no guaranteed prediction, and no shortcut. But the two-step strategy, when applied consistently, gives investors a logical, proven framework to build long-term wealth. Buffett became one of the world's greatest investors not by doing everything, but by doing a few things exceptionally well, and doing them repeatedly over many years. Jiwani's final message is clear: master the principles, stay patient, focus on the long term, and let compounding do the heavy lifting. With discipline, the two-step strategy becomes not just an investing method, but a lifelong financial advantage. Buffett's Two-Step Stock Market Strategy by Danial Jiwani delivers a clear, practical blueprint based on Warren Buffett's core investing philosophy. Instead of drowning investors in complex formulas, the book breaks wealth building down into two deceptively simple steps. 1. Find a wonderful business, and to buy it at a wonderful price. Every chapter reinforces this framework and explains how everyday investors can apply it with discipline and clarity. The book opens with Buffett's foundational principle: investing means owning a business, not trading a stock. Your job isn't to predict market movements, it's to evaluate long-term business performance. From there, Jiwani dives into what makes a business wonderful. These companies have durable moats, predictable earnings, strong returns on capital, trustworthy management, and financial stability. They operate business models you can understand clearly and explain simply. Once investors identify a wonderful business, the second step is determining whether the price makes sense. Jiwani emphasizes the distinction between value and price. Markets are emotional and often misprice companies in the short term. Buffett focuses on intrinsic value, the cash a company will generate over its lifetime. Only when price falls far below this value, providing a margin of safety, does the opportunity become compelling. The book also highlights the underrated power of dividends, explaining how sustainable payouts and consistent dividend growth reinforce the strength of a business and add to total long-term returns. Dividends also help investors stay calm during downturns by providing real, tangible cash flow. Jiwani devotes full chapters to common investor pitfalls, particularly emotional decision-making. Fear drives people to sell too early. Greed pushes them into overpriced or low-quality businesses. Both behaviors disrupt compounding. Buffett's strategy succeeds because it protects investors from emotional reactions and forces decisions based on fundamentals. The book also explains why over-diversification can hurt returns. Buffett prefers focusing on a handful of exceptional businesses rather than owning dozens of mediocre ones. Concentration rewards deep understanding and amplifies the benefits of compounding. When the underlying businesses are strong, Jiwani lays out important pre-investing steps as well: building an emergency fund, managing high-interest debt, strengthening saving habits, and defining your circle of competence. Preparation reduces emotional pressure and allows investors to stay patient and rational. The book concludes by bringing everything together. Success in the stock market isn't about complexity, predictions, or constant activity. It's about discipline. It's about buying businesses you truly understand and holding them long enough for compounding to work its magic. Buffett didn't win by doing hundreds of things. He won by doing a few things extremely well. And this book gives investors a simple, repeatable way to follow that same path. If this breakdown helped you see investing more clearly, hit that like button. It really supports the channel. And if you want more simple, practical summaries of the world's best finance books, subscribe and turn on notifications so you never miss a new episode. Got a book you want me to cover next? Drop it in the comments. I read every single one. Thanks for watching, and remember, stay patient, stay rational, and let your money compound.